Right now, the Iran war is shaking global markets. Oil facilities are being attacked, supply is getting disrupted, and investors are reacting fast. But here's something most people don't understand. When markets crash, money doesn't disappear. It moves. And smart investors know exactly where it's moving. In this video, I'll show you which Canadian ETFs and stocks are actually benefiting, what to avoid, and how to invest during a crisis like this. So you don't panic, you profit. This war is not just political, it's economic. A major portion of the world's oil supply flows through the Middle East, and when that supply is threatened, prices go up immediately. We are already seeing oil prices spike, and that affects everything. Transportation, inflation, businesses, and stock markets. When uncertainty increases, investors panic. They sell stocks, move to cash, and wait. That's why the market drops. But here's the truth. This creates opportunity, because while most people are selling, smart investors are buying. Now let's talk about where money is actually flowing. The biggest winner during war is energy. Because oil prices go up, profits go up. One of the most popular ETFs in Canada is XEG. This ETF holds major Canadian oil companies, and it has already delivered strong returns, over 20% plus in recent periods. Another strong option is ZEO. This one spreads money evenly across companies, and recently delivered over 40% one-year returns. And one more advanced option is HXE, which reinvests returns and has shown strong performance historically. If you want higher upside, you can look at individual companies inside these ETFs. Examples include Canadian Natural Resources, Suncor Energy, and Cenovus Energy. These companies dominate Canadian oil production, and they directly benefit when oil prices rise. Now let's move to slightly safer stocks, because they earn steady income from transporting oil. For examples, Enbridge and TC Energy. Even if oil fluctuates, they still earn revenue. Now this is important. During crashes, broad ETFs go down, but they recover over time. For example, VFV and XEQT. These are not short-term plays, but historically, they always recover and grow. Now be careful, some sectors suffer badly. Airlines struggle because fuel costs rise, travel companies slow down, and high-growth tech stocks fall due to rising interest rates. So don't blindly invest everywhere. History shows a clear pattern. War starts, oil spikes, markets fall, then eventually, markets recover. This cycle repeats again and again. That's why experienced investors don't panic. They prepare. If you want to win in times like this, focus on three things: stay calm, keep investing, and stay diversified. Some investors slightly increase energy exposure, but they never go all in, because balance is key. Now here's the risk. If this war continues, inflation could rise, interest rates may stay high, and markets could remain volatile. So this is not about quick profits. It's about smart decisions. At the end of the day, crashes don't destroy wealth, they transfer it from emotional investors to disciplined investors. So don't panic. Understand the market and invest with strategy. And if you want to learn more about investing in Canada, please subscribe to Maple Money Mindset. Because here, we don't follow fear, we follow strategy.